Hey KidVestors, it's your guy Wally. Let's talk about a stock market term you'll hear quite often, the PE ratio. But more importantly, we're going to discuss what is a good PE ratio. And no, we're not talking about physical education either. PE stands for price to earnings ratio. It's a simple way to measure how expensive or how cheap a stock might be. Here's the idea. The PE ratio tells you how much investors are willing to pay for $1 of a company's earnings. Think of it like this. Imagine your friend is selling a lemonade stand that makes $10 a year. If you pay $100 for it, you're paying 10 times its earnings. That means the PE ratio for your new lemonade stand is 10. Now let's make it even more real. Think about buying a gaming console from a friend. One console makes you $5 a month renting it out to others, and another makes you $20 a month. If each console costs $200, which one is the better deal? The one making $20 a month, right? That's basically what the PE ratio helps you figure out. It compares what you pay to what you earn. Now, let's talk about what's good. A good PE ratio really depends on the situation, but generally, a PE between about 10 and 20 is often considered pretty normal. A lower PE, like 5-10, might mean the stock is undervalued, or it could mean the company has problems. A higher PE, like 25-50 or higher, usually means investors expect the company to grow a lot in the future. For example, fast-growing tech companies often have higher PE ratios because people believe their earnings will increase quickly over time. On the flip side, more stable companies usually have lower PE ratios because they grow more slowly. So, is a high PE bad? Not necessarily. It just means investors are paying more today because they expect bigger earnings tomorrow. And is a low PE always good? Nope. Sometimes it's low for a reason, like declining sales or weak performance. That's why you should never look at just PE alone. Here are a few quick tips. 1. Try to compare PE ratios within the same industry. 2. Look at whether the company is growing or shrinking. And 3. Use PE as a starting point, not the final decision. At the end of the day, a good PE ratio is one that makes sense for that company's growth, industry, and future potential. So next time you hear someone say that stock has a high PE, you'll know exactly what they mean and how to think about it. Catch you in the next one. Wally out.
Hit that subscribe button so you don't miss what's next. And start learning on the KidVestors app, available on web and mobile. Your future portfolio will thank you.